We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelming on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Bob Coleman from Idaho Armored Vaults. Thanks for joining me today, Bob.
Hi, Tom. How you doing?
Excellent. It's good to have you, and it's good to have a more focused conversation instead of the Twitter spaces that we've been doing recently with you.
Yeah, we can be a little bit more focused, I guess you could say.
Yeah. I enjoy doing them, but they can turn into a bit of a handful sometimes, going off in stray directions. But I wanted to talk with you today about some of the changes that we've seen over this year. It's been relatively uneventful for metals investors, but there's obviously, lots that's happening under the surface. I think this is a good time to, have a conversation about some of the nuts and bolts in the industry and some of the, the pieces that we don't often, let's say, think about. So maybe let's start by talking about something that you touched on a couple times during the year here on Twitter, and that was, SLV shares being created. So when they create a bunch more shares, what does that mean? Is that more investors coming in? Is that more silver being bought? How does that work?
Yeah, that's a really good question. With regard to the ETFs and how they operate, the authorized participants are the ones that basically are contracted to provide liquidity to the ETF or to the market, so to speak. So their job is to not necessarily provide support for the silver market or whatever underlying investment that ETF represents. Their job is to make money on the interaction between the ETF and the underlying instrument that the ETF is actually invested in. So let's just take silver in this case. With regard to silver, with an ETF, it trades either at a discount, at par, or at a premium to the silver price or to silver itself. And so when things are trading, for example, when the fund is trading at a discount to NAV, it would benefit the authorized participants to buy shares in the open market and then take those shares, redeem them to the ETF, and take the higher price silver out from the ETF. There's an arbitrage there, that a profit that they can make. And just likewise, if the fund's trading at a premium to NAV, they can then take silver, give it to the ETF, and create those shares to sell those overpriced shares into the market and capture a profit there too. So that's the interaction that the authorized participants have in the marketplace. The hard part about this is a lot of this inventory is their own inventory that they're trading back and forth with the ETF. So there's not really necessarily new metal that's getting sopped up by saying, client 1, 2, and 3 are buying the market because they think silver's going to go up. They put their money into SLV or to any ETF. That may have absolutely no bearing whatsoever on the silver market in general. It may just be dealing with existing supplies or inventories that are being held at these authorized participants.
Right. So then when we're thinking about that in let's say the broader context of the futures market, how have the short and long positions in that market changed over the year as well, Bob? Like, it seems there's been kind of a bleed off in each direction at times.
Yeah, right now we're caught in a market environment in the silver market or gold market where you don't have much public participation in the physical market right now. It's just very quiet. And you can make assumptions of why it's that quiet. In reality, interest rates are not at zero anymore. They're at 5.5% on T-bills. So clients or customers have more choices out there that they can put their money into. It's not, we're not living in the zero interest rate environment anymore. Now you can actually get paid for saving money versus, you got to be forced to go into something to earn any type of interest. So that's taken a lot of bite out of a lot of asset classes, not just the metals, but you've seen volume levels go down, participation go down. you've seen, for example, the stock market, the top 7 stocks are most of the return in the stock market. And so you see this narrowing of action there. But in the world of precious metals, what's happening is the physical buyer not being center and forefront in the marketplace, you're now just having the market getting whipped either in a trade range or up and down motion of CTAs, commodity trading advisors, or hedge funds trying to game the direction of the market, but there's no follow through when you get to the top end of the range, right? When you think it's about to break out, it comes back down because people are taking profits. And the market, there's not enough depth there to kind of hold the price. And then it trades back down to the low end of the range. It looks like the market's going to, come crashing down below the trading range, and all of a sudden it just stops because you don't have any follow through to the downside. So you're just getting this churning action, and that's grinding this market, and it's killing the sentiment. It's getting people frustrated. You see the mining stocks not going anywhere except down maybe in a lot of cases. But the mining stocks, the problem with mining stocks is, they're getting hit with higher fuel costs, labor costs. You have the massive strike that's happening with Newmont mine down in Mexico, actually one of the largest silver mines in the world, where they're losing $3.5 million a day dealing with the labor strike down there. Those are real effects that maybe the financial markets aren't really recognizing, but right now we're just caught where you just don't have a lot of physical volume right now. It's due to that sort of, higher interest rate environment, and, there's more competition for the client's assets or their money.
Mm-hmm. Another one of the points that we've discussed before is the idea of borrowing costs to short shares like SLV or GLD. So how does that play into an indication on, when these markets are at extreme sentiment lows like this?
Yeah, what I kind of watch for with regard to the borrowing rates and shares available to short, that type of thing, that pool of available stock, is you're trying to get a gauge of when maybe things are getting a little too short, that you may see in this market. Some of these indicators are fairly decent, but when things get a little too short and you don't have the volume to see any follow through, those players, obviously, when you're short, you got to be very careful of a move back against your favor. So then you put stops in above the market. And so what happens is you got players that are watching both sides of the market that can run the market in either direction. So CTAs get momentum to the downside. They think things are going to break down, and they don't. And all of a sudden they got to start covering. If you start to see guys like me watching the market saying, okay, you got the borrowing rates are going up too much, or you're seeing, the short volume activities not pushing the market down, and you're seeing just no follow through to the downside. Those are times where you just get caught in that churning action where the market just goes nowhere fast. I mean, to the physical investor, we're watching this stuff and it's just noise, in all honesty. It's just the market biding time, waiting for some momentum or some sort of event to take you in a direction, either up or down, where you can get bust out of that trading range. And it's these trading ranges that create this, what they call consolidation. It creates this base, and whether the base is to the, for building for upside action, or it's a consolidation of a topping pattern and you start to break down, typically that longer that base, the bigger the breakout, when that breakout comes, is going to happen. And that's all part of what we all watch for as participants in this market is, well, which side is this thing going to break out? What would be the impetus to provide upside momentum to the market? And there's a lot of reasons, obviously, to be very bullish long term on the metals. The problem is a lot of people don't play the game of buying metal, physical metal, holding it in cash form. They attach leverage to it, or they play options. And those strategies, you can get whipped around before that move ever comes. Especially in options, you could have the expiration of that contract happen before the move ever develops. And so it's one of the reasons why I prefer physical metal paid for in cash. So there you're allowing time in the market versus trying to time the market. And that's, I've been in this game for a long time. The move always happens when you least expect it. I mean, those are the types of things that right when you think you understand what's happening, especially in the physical metals markets, you tend to get the rug pull right when it looks like it's got to blast off to the upside, or too many people are bullish or maybe expecting that the move up. That's when you get the pullback. But that's just the nature of the beast of the physical metals markets.
Mm-hmm. So, when we're talking about these pieces, Bob, is there one of these signals that is, more important to you than the others? Is there something that you're checking every day versus anything like that? Or are we just in this holding pattern until, in a way, we have this exogenous event that creates this move one way or the other away from this, let's say, $23.50 level in silver and 1920 level in gold?
Yeah, I mean, it's always nice to try and speculate of what's going to move the market, when it's going to move it. I mean, everyone, if that's one of the I guess the grandioser jobs of being a speculator and trying to guess. But in reality, the market's going to move when the market's ready to move. I mean, we don't have any power and control and can push with our eyeballs the pixels on the screen of where the prices are actually flowing to. So the best you can do is try to help educate the investor or the consumer and try and tell them, listen, this is what is happening right now. This is what we're seeing in the market, whether it's the short market or short interest, or whether it's physical activity, or whether like for example, last year you had a massive amount of physical activity coming from a demand coming from India and other parts of the world. Mm-hmm. And that was setting a tone that as the paper price was being pressed lower by CTAs and so forth, going short to market, you had this sort of beach ball mentality. The further you kind of hold it under the water, that when that move explodes in the other direction, it's going to move. And so we're all watching for the structure that's underneath the market that gives us sort of a tone to, well, what's going to break this thing out? And so, for example, you have a lot of central bank buying of gold, for example, and gold isn't breaking down. I mean, it's just interesting how well these metals are actually holding up, even though a lot of people are frustrated and maybe saying, well, why isn't silver at $30 an ounce? You got cattle prices at all-time highs, and sugar's going up, and orange juice going up, and all these other commodities going up, oil is going up. Why isn't gold and silver going to go up, or why aren't they up now? Well, every asset has its day in the sun, and in the way the markets kind of work, sometimes it's all basically a rotation game. And so once that money moves out of that one asset class or commodity group, and then it floats to the next one, maybe that's what will happen. It just takes that time for that rotation to happen, and that's what you're trying to watch for. You're trying to help explain to people how this whole thing works, rather than just saying, oh my God, JP Morgan's manipulating the silver market, and this thing's never going to go up. Because why would anyone ever want to get involved in a market if it's completely manipulated? Yes, there's management of prices everywhere in every market. I totally agree with that scenario. But there is, I think, from a silver investor's perspective, especially from the physical market, I don't think people appreciate how small the physical silver market really is. It's just being sort of oversimplified with all this paper investing that's been going on over the last 3 years, this creation of structured products and the ETFs and all these other types of unique pooled programs and things like that the industry uses to try to make money for themselves. But in reality, it may not be the best solution for maybe a higher silver price, because those programs may be using other types of instruments that represent silver, not necessarily silver itself.
Mm-hmm. I think this is kind of a good point to bring in the idea that you and I have talked about, I think probably every time we've spoken, is the idea of risk and counterparty risk. You were sharing with me before we started recording here this morning the idea that there are some of these programs that have bars that might not be liquid in this environment now, right?
Yeah, there. For example, there are digital programs out there that clients may have absolutely no clue or understanding of the actual bar makeup or the hallmarks that make up that program that represents that digital asset or digital metal representation. And so the question is, as you see this, two-way action that's been developing in the market since probably May, June of this year, where people are actually selling metal into the market, people are liquidating some of these programs because, the metal prices haven't gone anywhere, or they're just saying, I can just get 5.5%, putting it in risk-free instrument. At least they'll just take that. But these programs, may have Russian hallmarks, for example, that may not be deliverable or good LBMA delivery bars because they may have, because of the situation in Ukraine. I mean, there are extraneous events out there that create anti-money laundering policies and things like that, programs that may not have private labeled products and things like that may not go for the same price that LBMA grade refinery products go for. So those are all parts of additional risks. And then you take on top of the case where transactional volume has been really slowing in the industry, especially the last 3 or 4 months. A lot of these programs are designed to generate transactional activity so they can generate transactional fees, and people just sitting on metal or slowly liquidating the metal is not what these programs goal was designed for. So the question then is, they have fixed costs. They have to pay for the storage of the metals and so forth. And if they don't charge for that storage of metals, because that was their sort of carrot to kind of bring that investor over into that pooled program, that's another cash flow risk that program may run into. And that's just another, and then you got to read these user agreements. You got to look at the limits of liability clauses. There's a whole slew of things that you have to understand, from a client, what your liability is. And you have to understand what the sponsorship's responsibility is to the client as well.
Mm-hmm. How have the trend following algos changed their positions in the metals as well over the year, especially in silver, Bob?
Well, I think right now the market's just gotten really quiet. I mean, there's not, besides this sort of whippy trading range that we're in, there isn't much to really, there's no event. There's no real news out there that can tie into some sort of action that, for example, last year you had India and then demand and all that kind of stuff, and you had a lot of physical support from the public as well going into the market. And that was maybe making algos maybe more sensitive to certain price movements or news headlines, things like that. But in this type of environment, as really all the eyes are centered on the Fed and how much they're going to raise rates and what inflation's doing, and is the economy receding? Is it growing? What's the labor market doing? You have all these other events now that are creating, oddly, a foundation that's positive for the metals long term. And a great case in point is the UAW labor strike right now with the automobile manufacturers. That's big news. I mean, you're talking two massive companies with a strike going on at the same time. It's telling you labor is pissed. It's telling you that labor can't make a living. Their cost of living is going up, and what their wages aren't keeping up with what they need to survive or feed their families with. And that's an underlying tone. The labor strike down in Mexico, the same type of thing. The entire town's going on strike basically because it's affecting everybody. And as the cost of living rises around the world, as inflation rises, and it's a lot of times people say, well, look at the CPI rate. It's only this much. Well, the CPI, a majority of that is real estate, and what people don't understand is and that real estate isn't really real estate prices, it's owner's equivalent rent. So it's a statistic that's sort of manufactured by the government that maybe part of the reasoning behind that was to back in the 80s was actually to create this indexing that would allow inflation to rise, but they changed the statistical measure. So labor unions and cost of living increases with government programs wouldn't go up as much. They kind of using owner's equivalent rent in the past has been sort of a massive lag indicator. Well, now real estate is maybe possibly peaking and potentially rolling over, but now you have this lag effect with owner's equivalent rent. But that's just part of it. I mean, the reality is most of the public, the energy and food are big portions of their discretionary spending. And if if their wages aren't growing and their rents are increasing, or their cost of their houses, or to try and buy a house is going up, or just basically raising children in this environment, healthcare, whatever it may be, education, all those things are rising. It's just like the frog in the boiling pot of water that's being turned up slowly on them. And I think that's the instability that you're eventually going to start seeing in this marketplace, or or Main Street, is the frustration that's growing under the surface. You can see it, maybe not in asset prices, because everyone thinks as long as asset prices goes up, everyone's fine and happy. But in reality, I think the average American is, I think, hurting. I think and that's why, to me, gold and silver are sort of this idea that it's going to be an asset that you own during times of uncertainty, as the markets become potentially either unhinged or affected by these rising costs. And I don't know how the government is going to be able to satisfy that, because the government has its own rising costs. I mean, we just passed $33 trillion in debt last night, and yet gold is only off an all-time high by about 8%. But the sentiment right now in gold is back to where it was, close to the bottom of 2020. I mean, you'd think gold was at like an all-time low right now with the way sentiment is, but it's not. That's why what's happening under the surface, as these paper players are going short the markets and so forth, what you're actually seeing is bank participation, and you're seeing volumes on the futures markets starting to diminish. And I think that's going to create eventually some illiquidity that starts to develop in the marketplace. So when you start to see that move, whatever move that direction happens, I think it'll be accelerated or accentuated by people that are really set up on the wrong side of the market at that point.
Mm-hmm. Yeah, it's crazy to be talking about the idea of costs going up, especially in the miners, as we talked about. There was this headline recently that Biden is planning on trying to change a 151-year-old mining law that forces companies to pay a royalty between 4 to 8% on hard rock minerals like copper and gold. So, could that be, this obvious play by the government that realizes that they need to start raising more taxes and tax revenue? Or is that a step in the wrong direction towards nationalization of these assets?
I don't think it's nationalization. I think it's tax revenue. I mean, the funny thing about it, I kind of made a comment about it, is actually this may be a positive for the metals industry, because if the government wants that tax revenue, they may not prohibit the mining activity as much, as long as you're willing to pay the revenue or the royalty. And that may be their way of saying, listen, we're supporting this activity. I mean, it's you could go both ways in this direction, but it's the hard part with mining companies in general is the volatile nature and the uncertainty of not only the management of the company and the financial structure and financing and capital costs and that type of thing, but it's also location. It's also the ability to produce a set amount of ounces and find more production. I mean, those are the intricacies of owning mining stocks. But if the government is going to be supportive in nature, or let's say if you're willing to pay that royalty, they may be more supportive in bringing more projects online, and that may actually help the mining stocks longer term. But that'll potentially maybe bringing more metal into the market as well. But of course, then that metal will have that extra 6 or 8% cost to it. That has to be added on, and that's where it gets interesting right now, because the cost of production for gold and for silver is not cheap. I mean, silver, the primary silver producers are right about this level, the cost of production, and with gold, I think it's like $1,700 for example, for Newmont mines. I mean, it's not like these guys are, they're all in costs are $1,200 an ounce, and they could, that's why these stocks are languishing. They're not making a fortune at these prices. And that's why typically you've seen support in the market where you're near the production costs of mining. That provides a little bit of a floor here. And that's, I think, maybe one of the reasons why the metals are holding up so well, given the strength in the dollar, but given that interest rates have gone up so much over the last year and a half. I mean, those, if that doesn't knock the price of metals down from that perspective, that's now all of a sudden those headwinds become tailwinds.
Mm-hmm. So Bob, let's take a look. You did a kind of a study of the charts here and kind of comparing 2008 to the current chart, what we're seeing and why that is kind of an interesting indication.
Yeah. Okay. So looking at silver, what I did was, and I posted this on my Twitter feed, Profits Plus ID is my Twitter account. I looked at silver back in 2008 and 2009, which is this chart right here. And then I looked at the current chart where we're at right now. And what I always look for is I try to look at similarities in the marketplace, to try and get some sort of fractal pattern or some sort of repeating pattern that maybe give us a guide to, to what to watch for if that pattern starts to show itself again. And so in this instance, this was a chart that I did. It was basically a lot of inverted head and shoulders. You kind of mark these patterns out, the left shoulder, head, and then you got the right shoulder, and then it broadens out a little bit longer in time frame. And so what you're watching for in 2008, 2009 is you had this big crash that went from 17, down to $9 in the marketplace, the great financial crisis, and then the market started to rebuild again. And so what I wanted to do was look at, okay, as a very similar chart, you had this sort of trend channel that's been formed back in 2008, 2009, and let's look at today's action. Very similar in terms of inverted head and shoulders. This chart, I apologize, it's only through, I think, mid-August, but it gives you, the price it's gone up and down a little bit, but it hasn't really broken this, it's still formed this sort of inverted head and shoulders. But you got this sort of trend channel that's developed. You got this inverted head and shoulders pattern that's developed, very similar to what we see here. And then, so I said, okay, what happens after that? And basically, if we look at these little arrows right here, this is the point in time where we are right here back in 2008. This was what the 2008, 2011 chart ultimately did, was the market just basically was in a consolidation on that sort of inverted head and shoulders. This was the sort of channel, I guess you could say, right here, or the channel that was developing. But basically, it just slowly grinded higher. It kind of built that wall of worry. So again, what you're trying to do is you're trying to say, could the same thing be happening here with silver? And this is why September is somewhat of a very interesting month, because September tends to be sometimes seasonally weak in the metals. You see some pressure, and it tends to be seasonally weak in the stock market as well. And so you could get, potential sell-offs and downside action. So if the market can hold up well, it gives you a potential for going into the end of the year that you may have avoided a storm or the potential headwinds, and now you may have some tailwinds that developing on the backside that may help push it back higher again as this sort of consolidation kind of, or that base continues to grow. And that's what I kind of watch for, is you're just trying to read these, some people call them tea leaves, whether it's, technical chart action but the charts basically give you a view of how the market and participants within the market are sort of seeing the price action. That's all it is. It's nothing magical or scientific. It's you're just trying to get, the overall sentiment and how people are feeling about the market. It's sort of that overview. And basically, I did the same thing in gold. I'll pull up gold here. Okay, so with gold, this is the 2007 to 2009 market right here. Yeah, you had this big break in the great financial crisis. You had this rally back out, and then you had this sort of downtrending or sort of consolidation pattern that was developing in gold back in 2007 and 2009. And this is the 2017 to 2019 gold market. And you can kind of see a big breakdown in price, rebuilding, and then you had this sort of consolidation sort of pattern that was developing on gold. Very similar in terms of price action. Again, all we're looking for is just patterns that are building. It's not, we're not trying to dictate the market or the action of the market. We're just saying, okay, show us some fractal patterns that kind of are similar. And then this is the current gold market right here, 2022, 2023. Again, you had this smackdown last year in the gold market, bottoming in the fall, build back up in price, and then this consolidation that's been going on. And again, this chart is actually, I think it's right at the beginning of September. So there's about a week that's gone by, but you can kind of see the similar price action that's been happening, this sort of double top action and then in this consolidation. To summarize that action, we'll look at 2007, 2009, 2017, 18 timeframe. And this is the ultimate effect. What happened was these price points, when you had this sort of downtrend sort of pattern develop or consolidation, these little arrows mark where they were in that downtrend, kind of similar to where we are right now. The question is, are we going to do something very similar in this action where we break out to the upside? And that's obviously what a lot of precious metals enthusiasts are watching for is, one, what would do this, but two, is the market structured potentially for this to happen? And what you typically see here is people get really pessimistic in the marketplace, and ultimately what they do is they go short the market, or they just basically sell their position and say, listen, I'll come back into this market once it starts to get momentum to the upside or downside. What's interesting about this market is if you look at the MACD on this longer term chart, this is a monthly chart, but you can kind of see during these breakout points, you started to see this action. I'll kind of narrow it in here. You started to see this move up in MACD, this crossover, positive crossover. It's the same thing happened here, this consolidation here, and then you had this crossover where it started to break out. What's interesting right now is we're seeing this consolidation again, and the MACD is starting to lift up, which is a sign that potentially we could be getting ready to break out to the upside. But these, again, you're trying just to develop some sort of strategy or some sort of expectation of what's happening in the market. Now, this doesn't take into account fundamentals and all the news items that and events that hit us on a day-to-day basis. But when you start thinking about this and you're saying, well, $33 trillion in debt, and you got labor strikes, and you got energy going up, and you have, that adds uncertainty for the economy, especially going into next year, and you have the election. I mean, you could go on and on with fundamental reasons that would drive the price higher. But on the chart, that's the setup that you kind of see right now. Mm-hmm. And you have to respect that.
Bob, one of the other topics I wanted to touch on with you today is the idea of, the gold that is, let's say, being brought into China versus the amount of gold being traded in the West via the COMEX. So let's talk a little bit about, let's say, this pricing disparity that we've seen.
Yeah, a lot has been made from the premium of Shanghai versus the LBMA or London market in gold. And from what I kind of gathered, because I'm not an expert in Chinese politics by any stretch of the imagination, mm-hmm. but from what I've read, the Chinese may have had informal controls put in place to sort of thwart or impede the importation of gold into that country, because they're trying to hold the Chinese yuan or keep it, from maybe going down in value. And when people are buying gold, for example, they're selling yuan and buying gold in dollars, whatever it may be. And that's only hurting the value of the yuan. So in essence, what they try to do is they curb that activity, which ultimately you still have this thirst and this need to buy and own gold. Because if you look at the Shanghai numbers as of a couple weeks ago, the top 10 traders on Shanghai were actually at their largest long positions in both gold and silver I think, on record this year. And so there was a lot of people that were saying, listen, we're concerned about not necessarily industrial production and solar panels. We're concerned about a devaluation in the Chinese yuan, and we're trying to protect ourselves. And I think China probably picked up on that. And obviously, they tried to, maybe on an informal basis, tried to support the currency by basically saying, listen, if you want to own gold, you're going to pay up for it, but it's not really going to affect our external accounting and balance of payments, on a global basis. You're just going to pay up for the price for the if you really want to own it. It's kind of somewhat similar that happened in 2020, 2023, earlier, the last 3 years in our markets, where you had industry and a lot of retail dealers claim that the dollar was going to fall apart and that there's going to be shortages in metals, and all of a sudden everyone came in and started buying the metals, and you just had more people buying than available metal at that moment. And so what happened was it gave pricing power to the dealers out there, and they took full advantage of it and marked up premiums to a high degree, and the consumers that weren't going into the market didn't understand the market completely and didn't understand that there is premium risk. And they're now starting to see that pain of, oh my God, I paid $18 over spot for Silver Eagles, or $12 over spot for Canadian Maple Leafs, where now the bid on those things may be a couple dollars or $1.50 or whatever it may be. That's the part of the market I think that frustrates a lot of people. And that's probably something that many people just don't fully understand or comprehend, how the industry works in that fashion.
Mm-hmm. Well, as you're talking about physical premiums, Bob, how have they developed over this year, and are they at another low here because of demand?
They've crashed. I mean, you look at and they started to decline earlier this year. You started to see participation kind of slouch off. After you started to see that actually in the winter, and then you had the March banking debacle, and then you had this rush and event to buy metals. And then after that rush was over, and the Fed kind of calmed the market by using the bank term loan funding facility program, and they came into the market, supported the markets, and as interest rates were continuing to rise, and people started to get the sense that okay, rates are going to stay higher for longer potentially, that started to detract interest in the metals, because obviously metals don't pay an income, and that started to slow the market down. By about June, things started to really kind of taper off, and so you saw premiums of a lot of sovereign mint products going down to levels that we hadn't seen since really March of 2020, right when the COVID thing kind of broke out. You saw really the last product that had any type of pricing power was the Silver Eagles, the American Silver Eagle program. And of course, what ended up happening was, as the market sees, or there's less demand for other proprietary products, silver rounds, proprietary made bars, that type of stuff. All of a sudden, the mint had maybe a little bit of influence, or I should say influence, but maybe the refiners that were making those blanks now could make more blanks to the mint, because they were one of the few products that was still selling and had pricing power for the wholesalers out there. So what you ended up having was this a resurgence of blanks and an increase in allocations that the U.S. Mint was able to make 3 million more, for example, Silver Eagles. That amount of inventory that came onto the market, all of a sudden, the wholesalers and retail dealers didn't have the pricing power, because now you just had a bunch more inventory hit the market. So the premiums went from $10, $12, $15 an ounce over spot on the wholesale market down to $3, $3.50 over spot. And you got to remember that the U.S. Mint sells to the wholesalers as a distributor at $2.95 over spot. So you had just basically a crash of profit margins across the board. And what was the last big profit margin product, when that went, the whole industry now is seeing sort of a malaise or a slowdown. And unless an event happens or whether the prices break up or down, the worst thing that the industry could see right now is just basically a really tight trading range where the market goes nowhere for quite some time. And people just don't have the interest, or there's nothing to get them off the couch to start buying metal initially. Mm-hmm. And that's not necessarily a bad thing for the investor. It may frustrate them in terms of price and the price action of the market. But what it does to the industry is it starts to force this high profit margin business to contract. And so it brings premiums down, and eventually that may equalize the market. And then finally, people that have been sitting on the sidelines saying, I'm not paying $12 an ounce over spot for a silver eagle, or $8 over spot, maybe I'll buy it at $4.50 or $5, or whatever the number may be, that brings them into the market. And that's what you started to see. So as the premiums kind of crashed, you had a lot of pent up demand in silver eagles. That was seeing a lot of good volume still, but now that's sort of tapering off because, people are saying to themselves, well, okay, the premiums aren't going right back up. So obviously there's still plenty of supply in the marketplace. And on top of that, you have a rising demographic, or an aging demographic, that people that bought metal, not in the last 3 years, but maybe over the last 20 years, and they're getting older, and they may need that metal for life expenses, or to buy a house, or maybe to invest into income so they could get some sort of return on their investment, or some sort of income on a monthly basis, or quarterly, semi-annual basis. So you're seeing the market shift there as well. And so you're seeing, instead of the last 3 years where the only way to get metal was from new product, now you're seeing two-way action where you're seeing people selling back into the market, and that's also putting pressure on profit margins and premiums as well.
Mm-hmm. Well, Bob, it's crazy to think that a sideways market is less interesting than a market that's going down. But you're going to be speaking at the Silver Symposium here at the end of the month, and with Steve Sanangelo, if I'm not mistaken. And that has typically, or at least for the last 2 years, marked the low for the year in silver, right?
Yeah, I did a post on that on Twitter. Sometimes you have to have a little fun in the marketplace, but it is what it is. In the last 2 years, we literally almost to the day on the event saw the low in the markets. And again, you're just looking for anything that gives you some sort of sign or clue that, okay, could we be turning? Are we hitting lows in sentiment? Is it something where the market's washed enough people out that says, okay, we can maybe start moving up again? That's yet to be seen. But the idea behind it is, how much risk do I have buying silver at today's price versus maybe waiting for some sort of breakout. The problem we have with silver is it's a small market, and it can really get jerked around. I mean, it can really move very quickly in either direction. So and that tends to happen if we see a breakout to the upside, for example. It catches a lot of people off guard, and all of a sudden they don't want to chase it. The price moves even higher, and then all of a sudden any pullback becomes shallow, and they start buying on every pullback. That's typically how you start to build sort of a bullish scenario. And just like to the downside, if the market surprises and breaks down, for example, just because there's still no physical volumes, and people are just sitting on the sidelines waiting for something to happen, and you have the paper markets pressing the market lower, that may be the thing that actually brings people finally into the market to buy the physical product. So we're just waiting. I mean, it's tough to speculate on either direction right now because you're not getting any clues from the physical world.
Mm-hmm. So is there going to be any type of a content release from the Silver Symposium, or do people have to attend?
Yeah, it's a paid event. So I'll be hosting a breakfast, and then with a special co-host, Steve Sanangelo from SRS Rocco. I think he has a great story to tell. And I think it adds a lot of flavor of why the metals are going to do very well this decade. But I think it's part of this fundamental story that I think he can bring to the table and kind of explain very well. And then, of course, I'll be speaking at that breakfast as well, a little bit, taking questions. And then I have the afternoon, I'll be speaking more on the industry and sort of what the market's kind of seeing right now in the marketplace, what people can expect, trying to, again, answer questions with regard to, paper versus physical, for example, the pricing action and how it's determined and that type of thing. I think it adds a little bit of different flair to the marketplace or to these conferences, because it maybe helps answer some of these questions that, are easy to maybe be kind of answered by clickbait and by the idea that everything's manipulated. But in reality, things do happen for certain reasons. It may not be something to our liking all the time, but trying to explain this to people maybe helps them through this process of through the silver and gold markets, because it is a very small market. It's a very emotional marketplace. And then when it does finally rip, I mean, it gets pretty exciting pretty quickly.
Mm-hmm. Absolutely. Well, Bob, we look forward to hearing all about the conference. And of course, I'm sure there's more information available if you just Google the Silver Symposium. As well, your Twitter handle, Profits Plus ID, and goldsilvervault.com if you want any more from Bob, right?
Definitely. And it'll be the end of this month, September 29th through October 1st at the Caesars Palace in Las Vegas.
Perfect. Bob, thanks so much for your time today.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.